Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, February 11th, not the 12th. I'm a day ahead here. February 11th. It is 4:58 p.m. Eastern Time, and I'm coming to you from St. Augustine Beach, Florida with the big show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at key levels for next week, and update the world famous 21 over 21 leaders list. Big changes after the last day and a half in the market. Market state downgraded to consolidation with the failure of the January 31st follow-through day. That means we broke below the lows of that day. That essentially kills the rally. The rest of the action, if that didn't kill it, would have put a nail in the coffin, as we also closed back below the 200-day moving averages. Excuse me, 200-day moving average on the major indexes. You can see over here on the trend gauge, we're still neutral on leaders. 16 out of last week's 21 survived, so there are some pockets of strength, but we do have the arrow pointing toward bearish or downtrend. Short term and medium term, using the 5 major indexes, we are below the 21-day exponential moving average. We use that to gauge short term. We are below the medium term 50-day moving average, and we are neutral on the 200-day, back below it on the S&P. We want to get a second weekly close below it before we go full on bearish with that. But as you know, risk picks up when you're below the 200-day moving average. No bear market ever began without a weekly close below the 200-day moving average. So what happened today? As I said, rally over, S&P back below the 200-day moving average. Let's go through the key indexes. The G6, our growth index, down 2.24%. S&P down 1.9%. We opened slightly positive on the indexes, but it really didn't take long to turn to the downside, following up on selling that intensified yesterday afternoon after one of the Fed guys, Bullard, said he'd wanted to see an interest rate raised by a full percentage point by June or July. Market hated that. Then we also, during the day today, we saw escalated Ukraine-Russian tensions, which sent the market on another leg lower. All in all, not a good day. Rally killer. S&P down 1.9%, Nasdaq 100 down 3.2, Dow down 1.4, midcaps down 1.3, Russell down just 1% because oil's acting very well, joined by gold stocks today. 60-40 diversified portfolio down a little less than 1%. GROTECTION showing some nice alpha today, down 0.2%. The hedge that we put on yesterday really did its job. Let's get to the tail of the tape, but first let's get to the team here at Revere. Growing capital in uptrends, protecting capital in downtrends. If we had to sum up Revere in a sentence, that would be it. And if you're interested in this approach for your portfolio, very few asset managers, registered investment advisors do this. We think we do it pretty well. You want to hear more about our strategy, email any of us, Dan, Tim, Hunter, Merrill, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So, tail of the tape, along with the moving averages, and then we'll get to the updated 21 over 21 list as I blow up the indexes here a little bit so you can see very clearly here. Last 2 weeks have been kind of nutty. So big shakeout 3 weeks ago on a Monday. Any attempt to get above that level or below that level was met with buyers or sellers respectively, depending on what we're trying to do. We're below this big black line, the 200-day moving average. 2 weeks ago on Friday afternoon, we had a big rally going into the close and then followed up with 3 days of buying. Got us back above the 200-day, back above the 21-day. Then we got a gap down on 2-3, didn't go any lower. The 200-day held it. We went sideways for a little while, 4 days consolidation, which was a reasonable consolidation considering this move off of the low, this harsh 4-day move, strong 4-day move. And then we gapped up on Wednesday. Didn't get above the 50-day moving average. That's the red line there, but that's another close above the 21-day moving average. We really used that as our key for short-term strength. But for the second time, all we could get is one decisive close above. Then yesterday, terrible CPI number indicating inflation's not going away, compounded by Bullard piling on in the afternoon, closed below the 21. Then today, little move up after the open, but turned right back at this key 21-day moving average, which is now rolled over, and just selling all day. Additional leg down when the Russian news came out, clear close below the 200-day moving average, 0.8% below on the daily, 1.1% below on the weekly. So still in that range, right at 1% below that I use to gauge my 12 prior bear markets. All started with a close 1% or more below. So this last close below didn't turn into a full bear market, which is a 20% correction. Let's see where this one takes it. Obviously, the key levels now are the bottom of this recent consolidation, which is at 4,300, and then the low 42.23, which was a washout below the lows from October at 42.78. We'll talk about all these levels a little bit more when we get into the tail of the tape, but let's go to the Nasdaq 100 next. Couldn't get above the 200-day moving average. We went short yesterday afternoon. Took a quarter of the short off today, but we also cut some SSO as we went below the 200-day moving average. So this is very profitable. Also broke below the lows of this consolidation that we had from last week and the beginning of this week that we tried to break out of this week. So this is definitely from a failed move come fast moves situation over the last 3 days. Dow Jones Industrial Average, 34,738 was our close. You can see 2 miserable days. Again, another failed breakout. From failed moves come fast moves in the other direction. Below the 200-day moving average. Mid caps poked its head above the 50 and the 200-day intraday at the open yesterday, or sorry, during the attempted rally yesterday, but boom, down from 500 to 480, close below the 21, below all the key moving averages. No good news to be found there, despite some relative strength over the past week in mid caps and small caps, and that's primarily because of oil. Same situation here, relative strength on the small caps, but back below the 21, below the 50. This is the exact opposite of what you want to see from a healthy market. We want to see the 200. We want to see the red line, the 50 above it. We want to see the green line, 21 above the 50. We've got just the opposite setup here. So a lot of work to do for the market to right itself. Let's get to the tail of the tape now. So I mentioned we went from uptrend to consolidation with today's failure of the follow-through day. On the headwinds, added Russia-Ukraine, as it was very clear it was key to a leg down today. Got rid of Omicron as we are reopening all over the country there. So only 5 things serving as headwinds now to the market. I know they say the market climbs a wall of worry, but between the strong dollar, inflation, Fed tapering, rising interest rates, and Russia/Ukraine tensions, this might be a pretty steep worry wall to climb. Put call ratio spiked toward the end of the day to 1.13. VIX also up 14% on the day to 27. Once you're over 24, it's kind of dangerous in the market. Fear and greed at 34, that's fearful. So our bull case, it's over. Follow through day holds, leaders emerge, not happening. Back to the bear case right here, as you can see by the 4 arrows. S&P break back below the 200-day and the follow-through day failed. We got both of those today. I mentioned today's news. What I was watching coming into today was what could the S&P get back over the 21? Did try, bounced right up into it and rolled over. Bounce failed, and versus the 200 broken again. No good news in the tail of the tape today. I mentioned the trend accelerated in the afternoon. No strength to any bounce. All were used to sell today. And your bottom line here, rally over. Break of the follow-through day. S&P below the 200-day moving average. From a portfolio standpoint, we closed a couple of positions for small losses, ON, Datadog, and BX. We took profits in our short, trimmed our SSO. Strong today, oils, they love Russia. We bought NRGU today. As it broke into new high ground. Granted, it's extended. Would have been better, certainly, to get it back here near 300, but the strength in oil stocks was just too much to ignore, and I took profits in Devon yesterday, which went higher. All the oil stocks are going higher, as you can see. You'll see shortly in the 21 over 21 list. NRGU is a nice broad way to play big oil. Gold and silver stocks strong today also. Let's take a look. GLD, that's a pretty big move up, breakout from nice move off these prior lows. I got stopped out on GLD down here below the 200-day moving average last week, but I did get into Newmont Mining, which had a nice return for us today, up 5.5%. So gold stocks worked. Fertilizers continue to work. We own CF, up 4% today, new all-time highs. Fertilizers tend to move in sync with gold stocks. XLU and bonds, interest rates were lower today. Bonds were up, but that seems to be because of a bid on a flight to safety, bidding up things like the TLT here, which really undercut recent lows and then rallied off of that, but that didn't do anything to stop the indexes from going lower. So let's get back to the S&P 500 and our ranges here, and the keys that we need to watch out for next week. So yesterday, 210 broke below, never did get above the declining 50-day moving average. Let's go back to the S&P 500 over here. Never did get above that during any rally attempt. That's still downtrending, so that's very strong resistance here. Below the 100-day, broke below the prior all-time high at 45.46, broke below the 21-day exponential moving average. Here was yesterday's close. That was a positive expectation breaker after the gap up, nice move on Wednesday. But CPI and inflation put the screws to that, as well as jawboning from the Fed about really accelerating the pace of raising interest rates. So then today yesterday broke below the ADMA. We're here in this big range, 4278 to 4500. So you can see 4278 to 4500. This was the range while we were consolidating back in September and October. Broke back into that range today. Broke below the key 200-day moving average, which is 44.52, 44.64. You can see that there. That's the black line. So we're back into this shakeout range, which is this area here below the 200-day moving average. We're back into this area here. The primary consolidation range was from 42.90 to 44.50. That was these 4 days here. And then today's close, 44.19 within that. And then the next lower low, the last line of support, 42.23. We're 4.4% above that. So quite a bit down, but not a lot of support. Just this 1 week of support. We'll see. I mean, we're a bit oversold, coming down from 4,600 to 4,400 in basically 2 days. That's a pretty big 5% move in 2 days. But when risk picks up, risk has really picked up over the last couple of days, and we took our exposure from 1.4% midday Thursday all the way down to 0.24%. So basically the equivalent of 75% cash by trimming everything that we did. The things that were in are we got 4 holdings left. Sorry, 5. NRGU, CF I already showed. Newmont I hold. We're still in NUE. And Minor pullback on that today. Nice double bottom, very strong move up here. That's a steel stock. And Apple, still holding Apple, even though it did break below the 50 and the 21. Any strength, any bounce into there, if it fails, I'll probably use that to get out of Apple, as this was a fairly recent position that we took after its earnings. I know it's Apple, but there's no reason to hold on to a losing position. It's not like it's a significant tax event because we just recently got back into it after holding it off of the COVID low. So that's the tail of the tape. Let's get now to the 21 over 21 list. First of all, we always talk about the stocks that fell off the 21 over 21 list. So 5 were cut from last week. Let's go through those. Apple is the first one with its first close below the 21 since the nice move on earnings. Also sold out of Bros and yesterday, and it closed below the 21 today. Vertex was having a nice run, but failed breakout on that again. This is just a market where strength just gets sold down to below the 21, so that came off the list. Juniper, very strong for a very long time, but couldn't get anywhere. Again, strength being sold, another case of that, and closed right on the 50. This is still a strong stock, so if the market rights itself, this will be very close on our watch list, but a close below the 21. And MasterCard, which was acting very well after its earnings report, but harsh selling the last 6 days, taking it from 400 down to 370. So those are the 5 that came off the list. Let's look at the new additions to the list. So we've got 14 sectors, 21 industry groups listed here. Let's start with the new additions, the 5 new ones. Capri Holdings, nice earnings report, followed up, tried to move out. You know what happens when you try to move out in this market, slap back down, pull back, but very nice relative strength over the last 3 weeks, and we always like to get some retail stocks in there, as those are really the 3 key groups where William O'Neill made the bulk of his money: retail, medical, and tech. Second new one, Robert Half. This is commercial services and staffing. Good reaction to earnings. Tried to break out, broke out for 2 days, pull back over the last 2 days with the market. Nice looking flat base here. Commercial services and staffing, obviously with the economy opening back up and job openings everywhere. Note the relative strength on this over the past 5 weeks. Deere came off last week, but came back on this week after they reported that they bought a battery company. So is that good? I don't know if it's good, but the market liked it. But again, moved out, hit this 400 level, two levels of resistance here, all-time highs, and also a pullback from that 400 level. But Deere added to the list. Datadog on the list. We own this. We got stopped out on it as it broke below the low of yesterday, the gap up day. Still strength. One of the better tech stocks. Like to keep some tech on here if we can, especially a gap up on big volume. The volume here, 240% below, above average. Let's see what happens. We know what's happened lately as things gap up. They tend to fail. And Datadog so far holding in there, but honestly not optimistic, as it is a high PE stock. And finally, Newmont added. We own it. Ugly day yesterday, great day today. New 2-3 week highs. Let's see if it challenges the highs from January next week, as money definitely flowed into gold stocks and silver stocks today. The survivors from last week, Nucor, we still own this. Very strong, serious relative strength over the last 3 weeks. 6 or 7 oil stocks in here, and they're all acting well. Apache, this is an international exploration and production company. Booking, tempted breakout today, nasty reversal. Expedia did the same thing, came in with the market. These are showing relative strength, though. Relative strength stocks are what we want to have in this list. Note how great it's been acting over the last 8 weeks, and Expedia could easily be in this list also. Seagate hanging in there, still above the 21. Cheniere, oil and gas transportation pipeline stock, new highs. Arch Resources, coal, it's just 20% from pivot now. Serious relative strength. Anything energy related that's not green energy related has been acting well. Schlumberger, oil services stock near all-time highs. MPC, Marathon just continues to trickle higher. I think this is probably climbing the 5 EMA. Exceptional strength since its earnings report. This is a refiner. Archer Daniels, they service agriculture commodities, which is a hot area, acting very well, major relative strength. Lockheed Martin, with this Russia tension, we could certainly see some moves up in aerospace and defense stocks. We got Lockheed on here. Also keep an eye on Northrop Grumman NOC and RTX. Both had good days also. Corning still hanging in there, trending higher to sideways, broke below the 8, but still looking good. AbbVie continues to show strength. A little bit of a pullback the last couple days, very strong. Berkshire Hathaway, one of the better financials, continuing to act well. One of the strongest stocks in the market, down 4% today, but shipper, transportation shipping services firm Zim, continues to look fantastic. CF, we own this, all-time highs. Devon sold this yesterday just to lock in the profit. It's really had gone nowhere over the last 2 weeks. Just wanted to take the double-digit profit on it. Plus, it has earnings next week, and there's plenty of ways to play oil, namely NRGU, which we brought today. So that's going to wrap up the 21 over 21 list. You've got your levels for next week. Very critical that we hold on to the bottom of this consolidation area, being like 4,300 on the downside. First close below another close. Again, we had one 3 weeks ago. Spent a week underneath it, back below the 200-day moving average. Again, as you know, we preach constantly. This is where risk really picks up in the market, below the 200-day moving average. Definitely pay attention. And as always, like to hear from you. I'm on my email, don@revereasset.com. You can phone 855-REAL-WEALTH. Wrapping up the week ending February 11th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.